like to present you the paper, How do Shareholder Defaults Influence Corporate Governance in DeFi Lending. This is a joint work with Tim Dong and Paul Zhang. And well, the paper is much work in progress, so we're happy to receive lots of different comments. Let me start by giving a brief motivation. So, what is the biggest potential of blockchain technology? Well, it provides us a powerful instrument, not only for funding projects or creating marketplaces, but also for developing them and operating them in a fundamentally new way. So let me give you two examples of Aave and Compound. Both are peer-to-peer lending platforms, so you can also call them marketplaces, where we match borrowers with lenders. And these platforms are entirely managed through cryptocurrencies or tokens. In fact, they are operating as online communities, or as we just heard, as DAOs, where anyone can join, anyone can contribute, and anyone can participate in the decision making. And well, this leads to a scenario where users can borrow funds from this platform and also decide on this platform's policies. So these users hold debt as borrowers, and then they also hold equity-like governance tokens as investors. So if they can decide on these platform policies, well, as users, obviously they would rather prefer more favorable borrowing conditions, but then as investor, they would also have incentive to keep the platform more financially sound and revenue generating. So this dual role creates potential conflicts of interest, and this is what we are going to study in our paper empirically. Specifically, we ask what motivates users to participate in platform governance, and then how does their commitment to governance change when they experience these conflicts of interest, for instance, when they're under financial pressure. All right. To do this, we match users' governance participation with their borrowing activity across 77 DeFi lending platforms. And here I would like to show you an example of the Aave dashboard. So users can click on supply and provide assets to the platform as collateral. And based on the value of this collateral, they can borrow other assets and pay an associated borrowing interest rate. And when users face a potential loan default, they have several options. They can either supply more collateral, they can repay the loan, or they can simply default and get the loan liquidated. And we have data on all these activities. We have the collateral deposits, we have the borrowings, we have the loan repayments, liquidations, and in addition, we also collect data whether these users engage in swap trades on major decentralized exchanges, which gives us an indication how sophisticated these borrowers are. And on this Aave dashboard, you also see a button, Governance. This is where users can click and then participate in the governance. And by governance participation, as we just heard in the first presentation, it's voting on proposals. So in general, each governance token counts as one vote, and then any token holder can propose any change to the DeFi platform, and the community votes on them. Here I have a recent example from Aave again, where one of the community members proposes to lower the borrowing interest rate, and then also provides a summary of why exactly this is beneficial. And each of these proposals has typically about 3 voting choices, and then the voting period lasts for a couple of days. And for our sample of the 77 DeFi platforms, we collected about 4,500 proposals and have about 14 million associated votes. So, what exactly are now our findings? Well, first we start with the behavior of borrowers. And we see that borrowers mainly pledge more volatile native cryptocurrencies as collateral and then borrow stablecoins. Why exactly are they doing that? Well, they engage in yield farming and staking and also arbitrage trading. And about 20% of all the votes that we see come from borrowers. And the voting participation increases by 0.2 percentage points during the period in which they're borrowing, meaning that being a user provides only limited incentives to participate in governance. Well, financial distress is a much stronger driver for voting participation, among borrowers, those closer to liquidation increase the voting activity and also support specifically on the platform from which they borrowed and for loan-related and more user-favorable proposals, meaning that voters, as it seems, voters vote more for personal gain in the hope of improving their financial situation. As such, we believe token-based governance becomes more data-driven when more users participate in these governance decisions. All right, let me show you quickly our data. We have about 4 main data sets. The first one is the borrowing activity from the DeFi lending platforms. We also have users' daily token holdings. Specifically, we are interested whether users are holding governance tokens but then never use them. And because governance occur on many different platforms, we also check whether these governance or whether the users hold governance tokens on many different public blockchains. We have the users' swap trades, and we have also the voting activity and all the DAOs. Our sample period starts in August 2020 and runs until August 2024. We have about 40 million voting records, 2.4 million are from borrowers, and the 4,500 proposals. Okay, and from this data, we construct a new measure, how close those users are to default. So DeFi in general relies on over-collateralization. So for instance, users can borrow between 66 and 83% of the collateral's value, depending on the platform. And interest accumulates continuously, so the debt increases over time. But users must remain this over-collateralization ratio, meaning that the borrowing amount must stay below the collateral value. And in order to manage this ratio, well, users can provide more collateral, they can repay the loan, or simply get let it default and then get liquidated. And during this liquidation periods, or during these liquidation events, a portion of this collateral is sold to repay the debt and also some penalty fee in order to restore this ratio, for instance, of 66%. So such liquidation events are particularly costly, and users really try to avoid them. In order to measure how close those borrowers are to this liquidation event, we use the distance between the collateral value and the outstanding debt, and then scale it by the volatility of the collateral. Next, we construct our main variable of interest, which is voting participation from the user holdings and the voting records, and the variable is 0 if the wallet address holds governance tokens during the voting period, but then does not appear in the voting records. And we also verify whether the user's governance tokens balance exceeds the voting power of the smallest voter in a proposal, and this restriction helps us to avoid misclassification that users are non-voters. We also construct a support variable, which reflects one if the voter voted in favor of the proposal, and we also include time-varying user controls, which serve as a proxy how experienced these borrowers are in terms of DAO and DeFi in general. All right. Next, we use OpenAI GPT 4.1, most recent large language model, to classify proposal content into 2 categories. Loan-related proposals are anything where users can change the borrowing condition of the platform, and user-favorable proposals are those that reduce user costs or increase rewards in general. And to verify their accuracy, we ask the model to extract key parameters to provide a short summary of the intended change, and then to also assign a confidence score, how certain the model is about this classification, and also to explain its rationale. So with this, we can just review a sample of the proposals and then verify whether this classification has worked as intended. All right. Let me guide you now quickly through our results. So first, we start addressing voting participation in the borrowing amount to see the effect of being a user on the likelihood of voting. And they also include voter and portfolio fixed effects to account for time invariant characteristics. And we see on average that 1 unit increase in loan borrowing amount is associated with a 0.2% increase in the probability of voting, even when the borrower undergoes liquidation. Given that we have an average participation rate of about 27%, this represents like a 1% increase, which is economically small. So we conclude that being a user only provides limited incentives to participate in the governance. Okay, now that we know borrowing does not strongly motivate users to participate in the governance, let's check for conflicts of interest, specifically whether users become more active when they are under financial distress. So now we are regressing voting participation on our new variable distance to default, and we find that users moving away from the default, so their position becomes more safer, are less likely to vote, and in reverse, the users that move closer to default are more likely to vote, specifically by 0.3 percentage points. Again, given the baseline here, the average participation rate is about 3%. This represents like a 10% jump relatively, which led us conclude that financial distress is a strong motivator for the users to participate in governance, probably because they want to influence the decision on loan-related proposals or protect the loan positions, or put it differently, governance participation might be driven by personal risk rather than the interest on participation in governance. In the next specification, we also control for different user groups based on their experience level, and we see that the general effect doesn't really change. Moreover, we observe that financially distressed voters tend to vote more on the platform from which they have also borrowed from. And we also observe that financially distressed voters vote more on loan-related proposals and on user-favorable proposals, but in general the effect is much stronger on loan-related proposals. And again, this result suggests voters are voting more for personal benefit, maybe driven by the desire that we want to change the proposals in a way that benefits the user. Well, let me conclude. We study the role of users in token-based governance of DeFi lending platforms and examine why and how they vote, specifically when they are under financial distress or after experiencing liquidation. And our main findings are that borrowers in risky financial position are more likely to vote, and it appears that they vote in a way that promotes their own economic interest. And as such, the implication would be that token-based governance in DeFi lending may reflect more user preference, but then possibly at the expense of platform stability. Thank you very much.
This person is Alfred Lehar from University of Calgary. Alfred, 12 minutes. We will be running into, I guess, your break time, so 9:30.
Yeah.
We can cut into the break.
Okay.
No, I wanted to make it big.
Control A. Okay, perfect. So thank you so much for having me here at the conference and allowing me to discuss this paper. This was something, when I read this, I thought, wow, I always wondered about this. I think this is a very interesting idea. And I think I was always excited to learn more about this conflict of interests that users and governance holders have. So there's the one-slide summary. So who votes in DAO governance decisions for lending platforms? It's the users, and it's the distressed users, especially, who are very keen to vote here. So there's a bunch of interesting findings in the paper. So if you get liquidated, apparently you get frustrated with the platform and you don't vote anymore. the distressed users vote were more in loan proposals rather than in user proposals. And what I found that Valerie didn't talk so much about, what I find interesting is they looked at if these distressed users vote with other users or against other users, and they find that they vote more with other users. So I think there's a lot to learn more about conflicts of interest in this, from this finding. So let me come up with a few comments. In general, I think this is a very nice paper. I like it a lot, but as a discussant, of course, I have to give a few comments out there. So first question, is this good or bad what we see? And so this is a very hard question, and it's not obvious what the right answer should be. So in a way, here what we see is, think about the bank, and everybody who has a distressed loan gets to run the bank. Could this be bad? Potentially, yes, but I don't know. It's not totally obvious. On the other hand, we get here people that are engaged that also use the platform, so that could be very good to make the platform better. So what we do see here is with this user alignment where a lot of the distressed users vote together with the other users, that is a very interesting finding. Does that mean that only the distressed users really run the bank, essentially, run the lending platform? Is this what we see in the data? I'm not sure, but I think this is a very interesting question. So it would be good to have a little bit more thought on, or some conclusions about whether we should be worried about this or whether this is a good thing, what we see here in the data. So my second concern is that there's a distance to default enters the regression in logs, and that makes in a way sense, because if I'm far away from the default point, I don't care if I'm 10% further away or not, but if I'm very close to the default point, this makes a big difference. But on the other hand, if we think about just the general market movement, so just the crypto market increases by 10%, then the distance to default changes by 10%, but now we see if we translate that to logs, that now has a very different impact, just the regular market movement on the log distance to default for users who are well in the money and those who are more distressed. So I'm concerned if that causes some kind of econometric issues in the analysis here. So one thing that you could do is to say categorize users as, are you likely to default or not? Are you distressed or not? Have some kind of dummy variable as a cutoff. So there's an impressive number of 77 lending platforms in the sample. And to be completely honest, a week ago I could have named you probably 5 lending platforms. If you call me up, I could not come up with 77. So I looked a little bit into this. And there is a huge range of lending platforms, but they are very different. So number one, Aave, I looked a couple of days ago, has 22 billion. And number 8, we are down to 185 million. And number 77, if you look at ETH TVL, is MISO with a TVL of $13,975. So it's probably easier to influence the governance of MISO than the governance of Aave. And so there's also some heterogeneity concerns, right? If I'm kind of the evil borrower who wants to go and then borrow from a platform and then change the governance decision in my favor, I would not try that on Aave. I would try that on MISO. And so we might see some self-selection of people who want to borrow with the intention of screwing up the governance process later on to pick a platform that has a lower TVL rather than a higher TVL. And so it might be interesting just to repeat the same exercise with Aave and Compound or the largest 3 platforms, and just as a robustness check and see if you get the same results from that when you exclude the smaller platforms. So I hope you admire my great picture here. So I used a very sophisticated AI model to make it look as if it was drawn by hand on an airplane. So one thing that that worries me here is fixed effects, whether they capture everything that we really care about. So here's the default boundary, and there's the red guy who is more in distress, has a lower distance to default, and never votes. And then we have the green guy who votes, and one time it doesn't vote the other time. So if we have user fixed effects, what we see is that that the green guy votes when he's closer to default and doesn't vote when he's away from default. So that would be the finding of the paper. But the other question we might be interested in is, why does the red guy never vote and the green guy sometimes votes? And so I'm worried whether you can answer that question with fixed effects. And I understand that using the fixed effects is great because it controls for a lot of other heterogeneity, but here looking at it this way, what might also add some extra value and some extra robustness checks. And so Andreas has a paper where he looks at yield farmers, these bots that go and borrow a ton of stable coins and then reinvest at the same platform to harvest governance token, comp tokens, or whatever gets handed out. So are these highly distressed borrowers actually borrowers that are fairly safe because they borrow stable coins and lend stable coins and therefore don't really have any serious risk of liquidations? Are there similar types of strategies that might define the high risk, the distressed borrowers? And those bots are probably more active in the governance process because they want to increase the handouts, the yield farming rewards that they get, and not make them go away. More sophisticated users are more willing to take more leverage, and are those more sophisticated users then also more involved in the governance process of the protocol? Could this be a measure of user sophistication that's driving this? And we can think about what else? No, yeah, okay. So the last thing that could potentially go wrong, like this is DeFi, this is the Wild West, everything that could go wrong can go wrong. So could there be that the protocol creators are engaged in the platform in some kind of wash trading activity just to boost DVL, right? So if I start up a new, one of the small DeFi platforms, and I want to move up the ranks, I borrow, I lend to the protocol, probably using 2 different wallets, and I just make that to boost my TVL, to show up higher DeFi lemma, to fake activity, to attract more users to come to my platform. So could this be something that you observe? And those users might take then on a lot of leverage, and this leverage, these users might also be involved in the governance process, again, maybe to just fake activity on their platform and make the platform look more interesting. So another thing you can do in these platforms is to get some kind of insurance, right? So you could sign up with a smart contract that monitors your leverage and then self-liquidates before you get liquidated. So users who engage in something like that might have a different incentive than other users. So just a few minor comments. So the only thing I wanted to suggest here is that the last point, that where sometimes you partition the sample in subsamples and say here's one regression for this and one regression for that, to combine it in one regression for the whole sample and use an interaction term might lead more convincing findings and might show us something else that's interesting. Overall, great paper, I love it very much. Thank you so much for allowing me to discuss this.